All right, welcome back. So we're basically towards the end of the course. A couple of things that we'll cover over the next 2 weeks. One is obviously what we'll do today, this week, about financial crises and financial regulation. And the next week, we'll talk about the money supply process and how it acts as a fairly useful policy tool, a policy lever for us to be able to manage financial crises. All right. So that's where we'll close off with the course. So that's basically what's coming up. So let's turn our attention now to the topic at hand. We'll talk about financial crises and financial regulation. Right. So what we want to do here is talk about first define what a financial crisis is and what we think causes them. Right. And then we'll talk about the Great Depression, the financial crisis that occurred during the Great Depression. And then we'll talk about the financial crisis of 2007, 2009. And then finally, we'll talk about the regulatory cycle, right? So the cycle is usually is, okay, so there's a crisis, then there is a call for regulation. So the Congress passes more regulations. Then the financial firms this is generally a regulatory cycle. So there's a crisis, there's regulations framed to deal with the crisis. Firms adapt to the crisis, to the regulations, and then the cycle goes on. Once they adapt, they find new ways around the regulations, and then a new crisis is birthed, and then it keeps going on that way. So I'll talk about all of those things, but let's start with key things. Okay. So to bring it to, as usual, we want to motivate you with what's happening in the real world. And if you look back at some of the literature which was published and still getting published around right now, around 2016, 2017, a lot of papers started coming up that given the low interest rate climate that the US and most other advanced economies found themselves in, this was in the aftermath of the financial crisis of 2007, 2009. So how do you inject liquidity into the system? Right? When credit starts to dry up, how do you inject liquidity into the system? One way, one policy lever that we have is to reduce interest rates. Right? When the Fed cuts interest rates that cut gets propagated to all the interest rates in the economy, and that helps ease the cost of borrowing. So firms borrow more money in order to finance investments, households borrow more in order to finance consumption, and that's one way to generate demand in the economy and pull the economy out of a crisis, right? So in the aftermath of the 2007 2009 crisis, interest rates had been cut to the bone, and many economists and policymakers began to worry that if you keep interest rates low for so long, it could cause distortions to the financial system. Right? The general way in which we dealt with financial crisis is that a financial crisis happens, the Fed cuts the interest rates, the economy stabilizes, and the Fed starts to raise interest rates back up. But because the recovery from the 2007 2009 crisis was so anemic and so slow, the Fed had no choice but to keep the interest rates low for an extended period of time without a rate hike in sight. Okay, so the biggest worry with low interest rates is that financial markets and other asset markets might begin to experience what we call bubbles. Okay, so we'll talk about bubbles in a second. What do we mean by an asset price bubble? But the problem with a bubble building up in any sector of the economy is that it's very hard to identify a bubble before it bursts, right? It's really difficult for us to disentangle whether the increase in prices is because of secular increase in demand for that particular product or in that particular sector, or is it because of some kind of distortionary forces operating within that sector. So it's very easy to identify a bubble after it's burst, but it's very difficult for us to pinpoint that, okay, this is a bubble. You can begin to see the picture forming as the bubble is forming, but generally people want to believe in good news. They don't want to really, we have this hindsight bias where people and loss aversion, where most investors don't want to recognize bad news until you absolutely need to recognize the bad news. And these bubbles, they might keep going on for a long time. Okay, the second problem is that whenever a bubble like this bursts, a financial crisis, if the bubble is large enough and in a sector which is substantially big enough to affect the entirety of the economy, usually we might bursting of a bubble is accompanied by a financial crisis. And again, it's really hard to predict these financial crises because one, in the last 50 years or so of the, if you look through the data, that we've had like maybe 2 or 3 bubbles and crises, and so they're infrequent and they're hard to predict, right? So the question that we want to address is that what we know from the data, at least now that, we'll have more data and more information once the pandemic is passed, and we will recognize it as one of the most severe crises, financial crisis, to envelop the US economy and the world economy in general. But it's too early for us to start analyzing that. But let's consider the 2007-2009 crisis. It was considered the most severe since the Great Depression of the 1930s. Okay. Now, the question arises, was the severity of the 2007-2009 recession due to the financial crisis? So coming back to that age-old question that we started this course with, that the financial system is not the economy is not the financial system, but what happens inside the financial system has ripple effects on the entirety of the economy. And the question is, how much? What is the kind of entanglement between those two things? Okay. So let's talk first about what financial crises are and what causes them. So let's begin with very simply defining a few terms. So what do I mean by financial crisis? A financial crisis, as the name suggests, is any kind of disruption which chokes off this flow of funds from savers and borrowers, right? So we opened the course with this vision of the financial system as a market-based system in which borrowers and lenders meet each other. So borrowers who want to borrow money show up in the market, lenders who can lend money show up, and they negotiate with each other the terms of the um, borrowing agreement, and then these transactions keep happening day in, day out, all day long. Okay. Now, if there is any kind of disruption in this flow of funds from savers and borrowers, it chokes off what the financial system is designed to accomplish, and then we have a financial crisis, right? And it's important because, as we know, households in the economy and even businesses in the economy depend on the ability to borrow money, right? So all economic activity depends on this flow of credit through the system, because you have a nice bright idea, it'll take a few years to get it to fruition before you can see the rewards for it. In the meantime, someone has to extend you a line of credit for you to finance that idea. So the level of credit, the availability and the accessibility of credit is crucially vital. For households, it's the same thing, right? Households might want to buy a house, buy something expensive, buy something which is beyond the means of their current income, but they might rely on credit to finance some of these purchases, and then they pay back with their income over their lifetimes, right? Again, instead of, if we didn't have a system like the mortgage system, most young households wouldn't be able to buy a house, right? Because houses are prohibitively expensive, and most people, young people, would have to wait for many years, if not decades, before they've saved up all the money they need to buy a house, right? And in the meantime, the housing market, there's nothing happening. People will start buying their houses towards the end of their lifetimes and just keep passing it on to the children, and you might have a very small housing market in that sense. So economic activity in general, that's just one example, but economic activity in general depends upon this free flow of credit between savers and borrowers, and a financial crisis essentially chokes off that key pipeline which links borrowers and savers together. Okay. A financial crisis typically leads to an economic recession. So that's what we mean by the economy is not the stock market and the stock market is not the economy. But if there is a severe enough disruption inside the financial markets, if you have a financial crisis, more or less you can predict that it's highly correlated with a recession following, with an economy-wide slowdown, right? So if you look at the history of the United States in the past, most financial crises in the United States have been precipitated inside the commercial banking system. We already discussed quite a few key details of the commercial banking system. Okay. So what contributes to the fragility of commercial banking? Why is commercial banking in general such a problem child and is the cause of so many financial crises and recessions which accompany them? Okay. And the crucial thing to recognize here is that banks, by their very design, have this problem of what we call a maturity mismatch. Okay. So think about a commercial bank's operations. It takes deposits Depositors, leave their money in the bank. They expect to get paid an interest rate, but these deposits are short term, right? Depositors can, at any point in time, pull their money out of the accounts and use it for other purposes. So these deposits that are maintained at the bank are short term. But if you look at the if you think about the other side of the thing, the asset side of the balance sheet for a commercial bank, loans that the commercial bank made tend to be of a much longer duration. The mortgage is typically 15, 30 years. So it takes much longer for those assets to pay off and for you to recoup the money that you lent at the outset. So this is what we call a maturity mismatch, because assets are maturing on a shorter time span than liabilities are maturing on a much shorter time span than assets are maturing, and then it generates this kind of mismatch between assets and liabilities. Okay. As soon as you understand that there is something as of a maturity mismatch between the asset side and the liability side of a commercial bank's balance sheet, you straight away recognize that there is always going to be this liquidity risk inherent in this, because what does it mean? At any given point in time, a commercial bank doesn't have all of the money that the depositors have left at the bank available, right? Because they keep a portion of the money in the bank as reserves, and the rest of it is used to lend out or buy securities or do uh, any number of things. And if there is more uh, demand for liquid cash than what the bank is available in reserves, there is a liquidity problem that the bank faces, right? So we have already discussed this. An illiquid bank is not an insolvent bank. Insolvency, technically defined, is the situation where the bank finds that the value of the assets that it owns is less than the value of the liabilities that it owes, right? So the bank can sell everything lock, stock, and barrel and still not be able to meet all the liabilities it has on itself. And then you have a case where it's an insolvent bank, right? So we already discussed how an illiquid bank can turn into an insolvent bank when it's faced with a sustained bank run, right? If people lose confidence in the bank and more people want to draw their money out of that bank, and the bank only has some amount of reserves, then the bank has to start selling its assets in order to make up for, in order to generate the cash to give back to depositors, and pretty soon you might have a illiquid bank turn into an insolvent bank, right? So prior to 1933, the US didn't have any system of government deposit insurance. So you'd leave your money at the bank, and if you left the money at the bank, you live by the mercy of that bank's moral compass, right? So if the bank wanted to take your money and run away, there was no recourse. You and then nothing you could do, nothing much you could do about it. You have to take those losses, and you can imagine a system like that which doesn't inspire much confidence. Most people would much rather leave their money in their mattresses or in a safe in the house rather than leave it in a bank, which might just evaporate overnight. Okay, so when there is no deposit insurance, once the bank's liquid assets are exhausted, the bank would have to shut its doors, at least temporarily, right? For a brief period, the bank would say, okay, we don't have money to service your withdrawals right now. What we'll do is that we'll shut our doors for a little while. We have all these assets that we have. We'll try to sell some of these assets and turn them into cash, and then we'll open back up and make sure that you're made whole. Okay, but for that process to work itself out, you need to have confidence that the bank is capable of doing this. And the bank run happens when depositors who have lost confidence in the bank's ability begin to simultaneously withdraw so much money that everyone wants to get their money out all at the same time, that it forces the bank into an insolvent position and forces the bank to close, right? So in the absence of any kind of deposit insurance mechanism, the stability of the bank basically depends on the confidence of its customers, right? It becomes a confidence game of sorts. So contagion is a process in which a run on one bank is not just constrained to that one bank, but it basically spreads to other banks, and you have a full-blown bank panic. So bank run, a crisis in confidence in one bank resulting in a bank run on that bank might generate a contagion effect, which in turn turns into a bank panic, forcing many, many banks to all close at the same time, right? It's a situation many banks are experiencing runs at the same time, okay? So how do you stop a bank panic? That was the central question. which policymakers were pondering in 1907, 1908, after the 1907 crisis, where JP Morgan, the actual JP Morgan, was the only left big in town in order to bail out the financial system. And JP Morgan did, but the problem was that that was not sustainable. The banking system was growing, and not a few people or one person in that case could not like bring enough funds in order to rescue the entire system. And that's basically the uh, idea which births this notion of the Federal Reserve, that government has two ways in which they can attempt to avoid bank panics. One is to institute a central bank which acts as the lender of last resort, where liquidity begins to dry up within one bank and they can't turn to other banks because other banks are also facing some kind of liquidity problems. They can all turn to this one central bank, which has the ability to make short-term loans to these banks, so that the liquidity crisis doesn't turn into an insolvency crisis. The second way the government can inspire confidence in the banking system is to institute an insurance system which insures deposits, right? So if there is deposit insurance, people will have more confidence in the banks. The likelihood that there is going to be a sustained bank run is fairly limited, because people have confidence that even if my bank in which I've left my money goes under, I have this, they're covered by this FDIC, the Federal Deposit Insurance Corporation, and that they will get their money back eventually. Okay, so that's the two ways, right? So the lender of last resort is a central bank acting as the ultimate source of credit in the banking system, right? And the Federal Deposit Insurance Corporation, the FDIC, was instituted in 1934 to insure these deposits in commercial banks. So up to right now, the standards are that up to $250,000 in depositors' money is insured under the FDIC system. So even if the bank goes under, up to $250,000 of your money is insured and you'll get it back. Okay. So in order to avoid all of this, Milton Friedman, so, before we go there, the US operates on what we call a fractional reserve banking system, and most economies in the world operate on this fractional reserve banking system. So what does it mean? It means that the banks are not obligated to keep 100% of their deposits as reserves in their money and only make loans using the bank capital. Rather, the banks are allowed to keep right now about 10% of their holdings on checkable deposits as reserves. They need to hold that at the bank at any given point in time. The rest can be used in order to make loans. So in the 1950s, Milton Friedman, the very famous Nobel Prize winning economist at the University of Chicago, proposed that maybe we should move to a system of banking where banks are obligated to hold 100% of their deposits as reserves. Okay. So again, in 2010, Kotlikov of BU, Boston University, he also advocated a similar plan. He said that if banks are required to hold 100% reserves, banks would not be able to buy assets or make loans using the depositors' money. Rather, they would have to rely on bank capital, on the owners pumping up in enough money in order for the bank to make these loans or buy these assets. So if the bank went bust, it would be the owner's money that would be in peril, because 100% of the depositors' money is still at the bank. They can be made whole, and if there is any adverse crisis to it, only the owners of the bank and people who own equity in the bank, they are the one who bear the brunt. So, of course, if you have the system, it would mean that there is no chance of a bank run, right? So of course, if you move to 100% reserve banking system where you hold 100% of the deposits as reserves, obviously there is no chance of a bank run, because if at any point in time, if anyone wants to withdraw their money from the bank, you have all of their money sitting at the bank all of the time, right? You don't have to worry about a bank run. But the problem with that, such a system like that, would mean that you would have a much smaller banking system, right? You wouldn't be able to make as many loans, you wouldn't be able to invest in as many securities and other investments, because your pool of capital is limited to the amount of bank capital that you can use to capitalize your bank, right? Okay. So yeah, it's a double-edged sword. It's not just that, okay, you hold all of the money, all the depositors' money at the same time at the bank, that solves the problem. It definitely solves the problem of a bank run, that you wouldn't have a bank run on your hands, but it might not it might have the inadvertent effect of having a much smaller banking system and the access of credit being much more curtailed. Okay. And here you see what the story looks like, right? Banking panics and recessions. If you just goes through the history from 1857 to 1933, you can see that basically, except for two of them, 61 and 64, basically onset of the Civil War, end of the Civil War type periods when there is a bank panic. But for the most part, if you look through the history of bank panics, they've all almost inevitably resulted in an economy-wide recession, right? So from the 1857 recession until 1933, all but two bank panics were associated with a recession. So that gives you an indication of how important the stability of the banking system is to ensuring the stability of the entirety of the financial system, of the economic system, right? So here's a nice little diagram which shows you the feedback loop that happens during a bank panic, right? So there's bad news. So depositors question the value of a bank's underlying assets. So there's some shaky news about a bank that maybe their assets are going bad, maybe they don't have enough good assets and they might be insolvent pretty quickly. So as soon as you hear the bad news, what is your reaction to it? You might react by wanting to pull your money out of that bank. So depositors line up and they start demanding that instant return of their funds. And the bank, because it's operating on a fractional reserve banking system, has only so much liquid cash available on its hands. So it pays out these withdrawals till it runs out of all its liquid cash, right? So you have a bank which is facing a bank run. Now, as the news spreads, they realize that other banks which might have exposure to the bank which is facing a bank run might also be in trouble. So you might have a contagion where depositors begin to demand funds from other banks, right? And now, as as the contagion spreads, what do banks? How do illiquid banks generate liquid cash? They have to start selling assets. So you have a lot of different banks all selling their assets all at the same time. And we know from simple supply and demand, if there is a lot of supply of something, when the demand is held constant, the price of that needs to fall, right? And you have a decline in asset prices that the bank owns, and pretty soon you will have a decline in output, employment, asset prices declines, and it causes more and more bank failures because other people who've invested in these securities and in these assets along with the banks, they see the price of their holdings go down, the value of their holdings go down. So it has an economy-wide effect, and then that's more bad news, and that perpetuates this cycle, ongoing cycle. And at some point, you have to cut this entire chain off, right? Now you can wait until here to cut the chain off and say, okay, we're going to step in, or you try to cut it off right there, right? So when there is bad news with the FDIC and the lender of last resort, the point is that we can cut the entire cycle off right there, right? If we can break the loop right there, which is what between the FDIC and the Federal Reserve are designed to do, they're designed to essentially be a switch breaker in the loop here, right? So if bad news hits one bank, no one needs to panic. There's no bank run, there's no contagion, there's no bank panic. All you have is that a bank finds itself in trouble. It can, if it is illiquid but not insolvent, it can go to the Federal Reserve, get some short-term loans from the Federal Reserve, collateralize against the bank's good assets, and then it can basically make sure that the run is over, and then it can get over its illiquidity crisis. The other way is that if the bank is illiquid and also insolvent, which is to say its assets are not sufficiently, the value of the assets is less than the value of the liabilities, then there's the FDIC, the Federal Deposit Insurance Corporation. So depositors' money is still safe, and the bank just goes under, it just closes its doors, but the FDIC makes sure that the bank's depositors are made whole. So we're trying to just break this feedback loop right at the beginning instead of having to wait till it blows into a full-blown crisis. Okay. All right. The other thing that we want to turn our attention to very briefly is the other kind of crisis that you might find yourself faced with, which is what we call a sovereign debt crisis. Right? So let's talk about a sovereign debt crisis. Okay. So sovereign debt, as the name suggests, refers to debt which is incurred by a sovereign country. right? So a government of a country can issue bonds, it can borrow money, and why would it ever want to do that? Because it's the classic case, right? How do you provision for government services, right? So there's two ways to do this. Either you raise enough tax revenues and spend within your limits, right? So you collect tax revenues and then you use the tax revenues to provision for all these government services. Or you want, if you are spending, if your expenditure is greater than the tax revenues you collect, then you can issue these government bonds in order to plug the deficit, right? Plug the gap between your tax revenues and how much spending you have on hand. So governments routinely issue these bonds, and a sovereign debt crisis occurs when a country is having difficulty. A country like a business or a household might have difficulty in servicing its debts, in servicing its payment, interest, or making its principal payments on these bonds. Okay. So if the government defaults on its bond obligations, it will have to basically depend on tax revenues to pay for its spending. And even if a government doesn't default, it will have to pay much higher interest rates when it issues bonds, because now people have less confidence. We said what determines the interest rate on a bond, one key element of it is default risk. Now, as a country, if you've shown that you can default on your bonds repeatedly, every time you have to tap the international capital markets to issue debt, people are going to demand a higher interest rate from you in order to compensate for the higher default risk that you carry. And so it becomes much more expensive for countries to borrow money, right? So what happens when a country is faced with this? When a country is faced with this kind of sovereign debt crisis, it has two ways to mitigate the crisis. One is to try to raise taxes, and the other way is to try to cut government spending, and both things can put the economy into a recession, right? So if you raise taxes high enough, then what happens? People have less disposable income. If people have less disposable income, what happens then? People have less money to consume goods and services, buy goods and services in the economy, and that results in a decline in aggregate demand in the economy, and that slows down economic growth and puts the economy into a recession. If you try to cut government spending, again, it's the same kind of situation. So government is spending on essential services, on things that generate, employment and increase output in the economy. And again, you have the same faced with the same problem. A sovereign debt crisis can put an economy into a recession, right? So sovereign debt crisis, how do you spot them? They usually take the uh, result from two dominant circumstances. Okay, one is profligate spending by governments, right? If a government keeps running extraordinarily big budget deficits, which is to say every year the government raises taxes, but it spends a lot more money than it takes in as taxes. So what happens? The government has to borrow money, so it issues bonds. And the government keeps doing this over and over again because the incentives, a government is in power only for a short duration of time. The incentives is to kick the can down the road. You don't want to deal with the debt problem. What you want to do is that you made all these promises to your constituents that you're going to do this thing, the other thing, and the fifth thing. So you much rather just borrow money and spend on the services, call it, and try to get re-elected, and then kick the debt can down the road. And if a country keeps doing that, over time, a larger and larger proportion of its tax revenues just goes to servicing existing debt, right? Paying the interest on that debt and repaying the principals on that debt, unless you are, keep rolling the debt over, which is also a possibility, which is what you do. Okay. And as soon as you find yourself in a situation where these debt obligations take up a big chunk of the tax revenues that you're collecting, you can find yourself faced with a sovereign debt crisis where you might have to default or renegotiate the terms of these loans. The other way that a country stumbles into a sovereign debt crisis is if there is a severe recession, right? The economy slows down, your domestic economy slows down of the country. And then what do you have? First, your tax revenues are going to decline because less production, less taxes to collect, less income. So you collect less in taxes. At the same time, as the economy slows down, you need more and more government services. What happens when the economy slows down? When people are out of a job, they depend on unemployment benefits. They depend on government provisioning for other goods and services, right? Like, food stamps, what have you. So at a time when the economy is slowing down, not only are the tax revenues coming down, but also government spending is going up. And then you find yourself with soaring budget deficits. Again, there's a mismatch between tax revenues and government spending. The deficit grows, and how do you plug this deficit? You need to borrow more money. And this is what happened, right? You look through the history. Argentina is a great example of this, since the Kirchners had been running the country since 1991 up until 2 years ago. Argentina is this classic case of constantly facing a sovereign debt crisis. Every couple of years, Argentina is at the IMF looking for a bailout, and you see what the problem is. It's this classic problem where the tax revenues are not high enough to cut back on government spending, and the government spending is, governments are no incentive in cutting back spendings, because they made all these promises to their constituents that they're going to provision for all of these different things. And so they keep finding themselves in the situation. And following the 2007-2009 crisis, we saw the same situation envelop a lot of European countries, especially in Southern Europe, like Greece and Italy and Spain and so on and so forth, right? So they were all pushed to the edge of a debt crisis, and they were forced to adopt all these policies, which is known as austerity, right? Even Britain, to a certain extent, did the same thing, where they cut back on government spending by a lot, or they were forced to raise taxes by a lot. Okay. All right. Of course, the situation is more complicated than that. It depends on how large a tax base is, how easy is it to avoid these taxes, how good the tax compliance is, and so on and so forth. So you can read through uh, uh, these crises, what happened with Greece, what happened with Spain, what happened with Italy, what happened with uh, Argentina. And in a geopolitical sense, it's another dimension of it, is that when a country is faced with a sovereign debt crisis, the government in positions of power, they lose people lose confidence in that government, and you might have like the rise of more uh, either on either extreme, on either right extreme or left extreme. On the right extreme, you might have the rise of these extremist right-wing political parties, which promise to rein back spending as much as possible. They vilify the welfare state. They say people are too dependent on welfare, on government largesse to finance their conspicuous consumption, and so they might want to enact policies like that. And on the left fringe, you might have a kind of a movement which bubbles up, which says that, oh, people are too rich in the economy, so we need to raise more taxes. The way to raise more taxes, shouldn't cut back government spending, because government spending is supposed to be benevolent and it helps the poor and the marginalized in the economy. So we should go after the really rich people and raise taxes on them. So you might have these situations develop where you might have the rise of more extremist fringes. And if you see the story which is followed in Europe, after 2007 2009, you see the rise of all these more extremist parties gaining more and more shares in the more and more electoral support, let's say, everywhere from Viktor Orban in Hungary to Erdogan in Turkey to Syriza in Italy to AfD, the Alternate for Deutschland in Germany, and like the move directly precipitating in Brexit, and so on and so forth. You see that develop quite quickly. So in a geopolitical sense, it's a sovereign debt crisis is bad news for everyone, right? You want most countries to be run by moderates who have like a reasonable grasp of the facts, and that you don't particularly cater to one extreme faction of the political spectrum or the other. Okay. All right. So we'll then turn our attention to two financial crises that are important in American history. We'll first talk about the Great Depression, and then we'll turn our attention to the 2007-2009 crisis. So let's take a look at the Great Depression. Okay. What caused the Great Depression? What is the start of the Great Depression? And there's several factors. As usual, the story is quite complicated, and more research keeps coming out. Ben Bernanke, the former Federal Reserve Chairman, has done yeoman's work in literature for around the Great Depression. So if you're interested in this topic, I suggest that you take a look at the essays and the papers he's published on the topic. They're very well written and illuminating on the topic, but there's a lot of different perspectives on this. Okay. So the first part of it is obviously that it's precipitated by a financial crisis. So in October 1929, the stock market crashed, what's known as the Black Friday. And as stock prices plunged, household wealth goes down, right? So, if you hold a lot of your money in stocks, the value of the stocks decline, you feel less wealthy. So as household wealth goes down, there is a two-pronged attack. Now, who are the people who are willing to lend money to corporations in order to finance investments? They're rich people and the people who are invested in the stock market, whose wealth has gone down, so they're less willing to lend money. So investment essentially dries up. At the same time, as households feel less wealthy, there's lower consumption as well. People want to save more money, spend less money, and that increases uncertainty, right? And as the level of uncertainty goes up in the economy, there is less spending in the economy. So that's one version of it, the stock market crash in October 1929. That's a direct contributing factor to the onset of the Great Depression. The second thing is the Smoot-Hawley tariffs, right? In 1930, Congress passed what was known as the Smoot-Hawley Tariff Act, which basically raised these trade barriers, which led to these retaliatory tariffs on foreign um, uh, on foreign imports into the US. So the US raised the import duty on a wide array of foreign goods and services in order to uh, protect the domestic economy. You see this even right now when Donald Trump was running, that he wanted to raise tariffs on China because this is a way of making sure that your domestic uh, companies can operate from behind a tariff wall, so they have that advantage. But obviously, as soon as you raise tariffs, other countries are not just going to let your goods come in free, right? They're going to also impose retaliatory tariffs. That's what China did in the most recent case, and that's what most countries did in 1930. And then that also, what do you have here? As the other countries impose retaliatory tariffs, it reduces the demand for US goods in foreign countries, right? So it reduces the demand for US exports. And again, if there is reduced demand for US exports in foreign countries, you need to produce less and less of them in the US because there's not enough demand to absorb them into foreign markets. And as soon as you cut production and output, what do you have? You have a recession. You have a slowdown in economic growth, right? The third key explanation, and one which has been studied, is also about restricted immigration, right? This is a period where immigration, there had been a huge influx of immigration from Europe for nearly 100 years at that point, and there was a growing concern that there were more and more immigrants coming into the US. This is not new. This is an issue which has been plaguing the US for a long period of time, and there was legislation that was passed which restricted immigration, right? And Immigration Naturalization Acts were passed in order to reduce the amount of immigration into the country. But as soon as you reduce immigration, what happens, right? If you reduce immigration, now you don't have a global talent pool and labor pool to attract your country to work. You are only reliant on domestic labor in order to get them. But if your domestic labor pool is also aging and it's not getting replenished at a fast enough rate, this is what was happening because population growth rate was declining. And we see that again and again, as countries get richer, the population growth rate declines because people have fewer and fewer children. The more, both parents are usually working and the nuclear families are formed, and you have all of that. So on the one hand, population growth rates were declining in the US. At the same time, there was an increase in or there was the increased restrictions on immigration to country. So that basically begins to shrink the labor force in the economy. And as you have fewer and fewer workers, you have lower and lower output, and that's what happened, right? And the other ripple effect of all of this is that at the end of the day, you need people who want to buy houses, right? So the people who are already in the US, they have a house. Most people don't buy a second house. If they buy maybe a second house, it's a vacation home or a rental property, and that's a small fraction of it. Most people buy one house, a single house in their, or own a single house in their lifetimes. And one reason why you might have housing demand is if more people are coming into the country. If you have immigration, these people need to live somewhere, so they want to buy houses, so you can keep housing prices keep going up. But again, in the 1930s, one ripple effect of all of these immigration policies was that housing markets began to collapse. Okay, so there's, you have the usual explanations. One is obviously the stock market crash. The second thing is to think about the tariff angle, the Smoot-Hawley tariffs and the retaliatory tariffs that followed. And the third thing is to think about immigration policies, which affected the supply of labor in the US. Okay, and here we see a couple of key things to see here. So 1929 October, right? This is where we set it at 100. So here you see what has happened to the key metrics. Real investment in the economy drops off precipitously as the stock market crashes. Investment basically takes a huge nosedive. From a level of 100, it falls to below 18, right? That's a massive decline there. Real GDP falls by almost 20%, right? So from 100 to 80, it falls almost by 20%. Consumption falls by less than real GDP, obviously, because this is the size of the economy. Only a fraction of it is, a lot of consumption is non-discretionary, which is to say you need a basic level of living. You need to spend at least some amount of money on basic necessities like food, clothing, and shelter. So you're not going to have you're going to have mirroring effect between GDP and consumption, but falls in consumption are almost always going to be smaller than the falls in real GDP. Okay, so consumption falls, real GDP, the size of the economy falls, growth rate in the economy falls, and the investment begins to fall. What is a consequence of all of these three things? If investment is falling, you need fewer workers to work in your factories and your shops and what have you. If the economy is slowing down, again, you need across the board, you need as many people. And if consumption is falling, you don't need to produce as many goods and services. What happens? What is the consequence of all of it? The unemployment rate, which stood at about 4% in 1929, rises to about 25%, peak almost 23.1% or something like that, well over 20% in the 25% at its peak of the Great Depression. So 1 in 4 people are unemployed. And over the next decade, as the unemployment rate came down, but even for at the end of the decade, it was still very high, right? It was still over 10%, which is historically high by US standards, right? And the only way all of this was beginning to recover, as you can tell, by 1939. But the onset of the Second World War in Europe really provided a fillip for all of these things, because as the Nazis began to take on Europe, and Britain was the last remaining force on the continent which was fighting off the Nazis. The US entered the war in 1942 after the bombing of Pearl Harbor. And as soon as the US entered the war, the US had to produce all these goods and services. So they were already supplying the war effort in Europe, even though they were not directly fighting in Europe. They're supplying the war effort in Europe. So that provides a huge fillip to the economy, because now you have to produce all these armaments and all the things that you need for war, and that increases production and drops unemployment rate. And at its very lowest, the unemployment rate was under 1% in the US at the height of the war, because every able-bodied person was either producing something in the domestic economy or was employed to fight the war in Europe, right? All right. The other thing, this is coming from Robert Schiller's book, Irrational Exuberance. The other thing you see is the run-up in stock prices. So if you look at the 1920s, so if you've read The Great Gatsby, I hope if you haven't, you should. It's Scott Fitzgerald book where he coined this phrase called the Roaring Twenties, right? So the book opens that way. So the Roaring Twenties basically refers to this movement in stock prices, right? You see that like the stock market between 1923 to 1929 almost triples, right? Because if this is about 9 and this is about 30, it's almost a tripling, 3 times as much, right? And the Federal Reserve saw this huge rise in the stock market and thought, okay, this is concerning because it's very quick. There's a very rapid increase in the stock market. And they decided, okay, maybe it's because there's too much credit availability in the market and people are taking speculative bets in the stock market. So maybe we should control this by by increasing interest rates, right? So the Federal Reserve raised interest rates because they saw these rapid increases in stock prices in 1928, 1929. But as soon as you raise interest rates, what happens? You reduce the amount of credit which is available in the economy, because at a higher interest rate, fewer people want to borrow money. And as the interest rates were increased, these asset prices began to collapse. What is the reason for that? How do you find the price of an asset? It's just the present value formula. If the cash flows, the numerators are staying the same for these businesses, but the discount rate, the interest rate that you're applying to them is now higher. What happens to the price of these assets? It falls, and that's what you see. There's this precipitous decline in the stock market following the increase in interest rates. Again, this was well intentioned. They saw that the market was overheating, but then they didn't. They thought the market would correct, but the market didn't just correct; it just collapsed. Okay, and so the decline in stock prices from 1929 to 1932 is perhaps the single largest in U.S. history. So you see what happened, what the effect of these policies were. Okay, so accompanying all of this was a massive increase in bank failures and bank panics. Okay, so this is the number of banks suspending payments to depositors. So this gives us the evidence of banks which are faced with a bank run. And you see at the height of the crisis, right, it has peaked in 1930, again peaked again in 1933, when a lot of banks started going bankrupt, or were facing bank runs, because more and more people were losing confidence in the banking system and withdrawing more and more of their money, and you have a full-blown banking panic. And it was in the aftermath of this peak right here, as this peak, when the government essentially introduced the FDIC. In 1934, the Federal Deposit Insurance Corporation was formed, and that basically is one of the more successful policy measures you can take. A bank panics, which numbered about 4,000 in 1933, fall to under 100 or under 50 by 1934, and basically have stayed like at a very low level since then. Okay. The other thing to recognize about the Great Depression is to understand what we call the debt deflation process. Okay, so let's briefly. Okay, so when we talk about debt deflation, it's a double whammy, right? This is a situation where the economy, where the asset prices in the economy are falling, but also the price level is also falling, which exacerbates the severity of an economic downturn. So what do we mean by that? So if you find yourself in a situation where the assets that you own in the economy are losing their value, at the same time, the things that you can sell and receive money for, the sell goods and services for, the prices of those things are also falling, and you have a double whammy. Not only are the asset values declining, but also the price level is declining. So that's the double whammy here, the debt deflation process, and that can basically exacerbate the severity of the economy, right? So as the economic downturn worsened during the depression, so what kept this is basically explanation for why the Great Depression continued for as long as it did, for over a decade. The price level would fall. When you have this debt deflation process and the price level is falling, it would have two negative effects. On the first order level is that real interest rates would increase, because if you remember the Fisher equation, the real interest rate is the nominal interest rate minus the expected inflation. If that expected inflation rate is going to decline, because if prices are declining, the expected inflation is declining, it means that the real interest rates would increase. And if the real interest rates are increasing, the real cost of servicing in terms of goods and services, the real cost of servicing debt is increasing, and that makes the already stressed situation even worse. Okay. The second problem is this where situation where we find ourselves, where the asset prices are falling, there is prices of goods and services are falling at the same time, and that increases the amount of bankruptcies and defaults, and that in turn can increase the severity of an economic downturn. So the having this deflationary pressure on the economy at the same time as it's undergoing a financial crisis is will most certainly exacerbate the situation. And that's what we define as the debt deflation process. Okay. All right. So what do academics and people who do research in this area, what do they have to say as to why, what the failures of the Federal Reserve System were? Because the Reserve System existed before the onset of the Great Depression, right? The Federal Reserve was instituted in 1913, and it was supposed to perform this lender of last resort function. And why did it fail to staunch this uh, first big test of this new institution during the Great Depression? Many competing and they competing focus areas of academic literature on this, but together they form a cohesive picture. And the first thing was that no one was in charge, right? So what this line of research suggests, that the power within the federal system was fairly divided, and the Fed had much less independence than the executive branch, right? So any decisions where you had to decide whether you were going to intervene and how large intervention, and all of the other policy discussions, where it's very hard to build consensus when the power in the structure of decision making is as dissipated as it was. And that led to some reforms in the Fed, which formed the Federal Open Market Committee, which was a much smaller body drawn from the Fed, which was given the mandate to manage this process. The second big explanation which is offered here is that the Fed was quite reluctant in order to rescue insolvent bonds. The Fed was overly worried about this moral hazard problem. So the idea is not very hard to fathom. This is similar criticism that was leveled at the Fed during the great financial crisis of 2007, 2009. And the argument is straightforward. Banks got themselves into this mess, right, from their own profligate lending and spending and investment, risky investment activities and all of that. So if banks got themselves in their own mess, if the Federal Reserve steps in and rescues them, then the banks would not fail and they would not learn their lesson. So then everyone would come to believe that if there is a financial crisis, the Fed will always come to the rescue, and they don't have to be as careful about the kind of risk that they take, right? And so the Fed didn't want to want to give the impression that it was contributing to the moral hazard problem. So it was much reluctant to rescue insolvent banks. The third key body of research which suggests what the problem here was is that the Federal Reserve didn't really understand this difference between nominal interest rates and real interest rates. It thought that if it kept the nominal interest rates in check, everything else would fall into place. But if you keep the nominal interest rate in check, you might feel like you're doing something policy-wise. But if it's accompanied by the debt deflation process, in which case you have falling prices, then the real interest rate is actually higher, right? So with the price level falling, real interest rates were much higher in the early 1930s than many policymakers in the Fed believed them to be. They thought that the interest rate was low enough, but they didn't realize that what they thought was nominal interest rate in the economy, the nominal interest rate, they didn't adjust for the fact that this expected inflation was falling because prices were falling and the real interest rate was rising as a consequence. The last part of it is more or less this puritanical strain which runs through the country for us, for this country in general, but in most countries, is that all of this mess that was a Great Depression was caused by speculative excess, and the Fed wanted people to feel the burn, like people, especially people who took on risky ventures, that many Fed members believed that the depression was a result of financial speculation. So the Fed followed what was known as a liquidationist policy. They would allow the price level to fall, and weak banks and weak firms and would fail, and in their place, stronger banks. There would be consolidation, stronger banks which were much more prepared or less risk loving than other banks. They would survive, and they would form the backbone of the new economy that they would build on top of these firms and banks that survived the Great Depression. So you have a lot of these different explanations, and all of them have their own merits, but like together they paint a cohesive picture that there was the moral hazard issue to consider. There was a liquidationist policy that the Fed followed. The Fed failed to distinguish between the nominal and the real interest rate. and that this power structure within the Fed itself was so dissipated that coming to a consensus as to what to do was fairly hard to come by. Okay. All right. So that's a, you know, a 30-minute session on the Great Depression. Obviously, reams and reams of paper have been written about it. So if you're interested, especially Ben Bernanke's work on this the entire book is called Essays on Great Depression, which is wonderful. Yeah, you should just, if you're interested in this kind of discussion on the Great Depression, you should definitely go take a look at it. Okay. All right. The other financial crisis that we want to turn our attention to is the 2007-2009 financial crisis. It was the single largest crisis that the US economy faced since the Great Depression in its magnitude. Okay. As usual, the story needs to begin somewhere. And the story that we begin the 2007-2009 crisis with is the story as old as time, that the housing bubble burst. Okay. So between January 2000, so if you looked at the Case-Shiller index, which was looking at housing prices, between January 2000 and May 2006, house prices more than doubled. At the same time, in the same period of 2000 to 2006, rents increased by only 25%. Okay. This is what we take to be evidence of the formation of a bubble in the housing market. Why is that the case? If you think about the two options that you have to live, you can rent your house or you can buy a house. These two are substitutes for each other, right? If you paid attention in your intro econ courses, these two are substitutes for each other. So if these are, and they are very close substitutes for each other. On a day-to-day basis, does it really matter whether you rented a house or bought the house? On a day-to-day basis, no. There are other discussions around why it might be better to buy a house sometimes and why it might be better to rent a house in other situations. But on a day-to-day basis, they form the same function, which is to say the prices of these two objects need to be fairly close to each other. Okay. So between January 2000 and May 2006, there's this big mismatch which opens up. Housing rents are going up, but they've only gone up 25%. In the same period, house prices have gone up twice as much, right? Double, right? 4 times as much. Okay. So home prices then began to decline in 2006, right? The subprime mortgage crisis is underway. So, you know the story where banks ran out of prime borrowers to make mortgages too. So they lowered their lending standards and started lending money to households which didn't have as good finances, right? Or what were known as ninja loans, like no income, no job, no application loans that they were making out. So the principal payments on some of these mortgages was coming due, and there was growing defaults in that sector, in the subprime sector. Okay. Now, so far, everything is okay. Okay, so there's more defaults. The banks knew that there would be more defaults in the subprime mortgage market. They're not dumb. They know that they're lending to more risky borrowers. So they understood that, yeah, there would be higher default rates. But the understanding always was that, okay, they default, the loan is collateralized by the house. Okay, so the bank takes over the house. So the bank forecloses. So lenders began to foreclose on these homes. But lenders don't want to sit on an empty house. It doesn't make any sense. So what they wanted to do was to put a house back on the market and sell it off to somebody else who could afford to buy it, and then they would go about their merry. But as a lot of as the housing prices began to decline, a lot of people started defaulting on the mortgages all at the same time, and a lot of houses started coming to the market for sale all at the same time. So what do you have? You have decline in housing prices. There's an excess supply of houses in the market, which means that housing prices are going down further. As housing prices go down further, more and more homeowners are quote unquote underwater on their mortgages. So if the house was worth $1 million when you took your mortgage, if it's worth only $500,000 today, why would you continue making, even if you have the ability to make those mortgage payments, it doesn't make any financial sense for you to make those mortgage payments, because you're paying for an asset which was valued at $1 million and you took a loan against that $1 million asset valuation. Now it's worth only $500,000. The prudent thing for you to do, the financially astute thing for you to do, is to stop making mortgage payments. Tell the house you're welcome, bank you're welcome to the house, and just move out. Okay, and that's what happened. And as the credit crunch tightened, as the banks were faced with this distress, they started to slowly tighten requirements for borrowers. On the one hand, they had a lot of houses sitting on the balance sheet that they wanted to sell. On the other hand, they were tightening credit requirements for people who wanted to buy a house. So not only are you flooding the market with a lot of supply of houses, but you're also, on the other hand, reducing the demand for houses. So you're doing a double whammy. Supply is increasing, demand is falling, housing prices collapse as a consequence, and they continue to fall as a consequence, as the home buyers had trouble obtaining mortgages, right? The people who even could buy a house were priced out of the market. And here's the classic picture that I absolutely love. Here you see what the mismatch between rental increases and housing price increases. Given that renting and home ownership are close substitutes for each other, the prices should be slightly higher. Maybe there's a slight premium for home ownership than there is for renting, because at the end of the period you will own this house after 30 years, whatever it is. So they should be, maybe there is a small premium to be had from housing prices. So that explains why housing prices might grow slightly faster than rent. But this right here, there's no explanation for, right? This is the housing bubble in full view. Housing prices are increasing at a much, much faster rate than rents are going up. And even if you bought a house, and if you buy it for investment property, you're buying it at a valuation which is four times the growth trend in the rents that you would get from that house. It really doesn't make sense. So this is the buildup of the bubble from 1999. You can see the divergence between rental and housing prices. And by 2004, you can see there's big gaps opening up, and then you see the collapse of the market, and then there is again some kind of a balance which is restored. Okay. What is the consequence of the housing market collapsing? So we see in this story before, housing bubble pops, banks are exposed to these mortgages. So in August 2007, BNP Paribas, the French bank, announces that it won't let investors to redeem shares in three investment vehicles that they had, which invested heavily in mortgage-backed securities. And that was already quite concerning. August 2007, if you were an investor in one of these three more MBS funds that BNP Paribas had, you couldn't get your money out because they couldn't do much about that. March 2008, the crisis begins to envelop other banks. There is decline in the values of mortgage-backed securities are losing their value, obviously, because mortgages are losing their value. More houses are there, housing prices are collapsing, which means these mortgages are worth less than what is anticipated. And Bear Stearns, one of the largest financial institutions on Wall Street, is really, really exposed to the mortgage-backed security market. And the Federal Reserve has a problem on its hands, and it decides that, okay, it has to rescue Bear Stearns. Fine. So the Fed response, obviously, the way it was designed to, because they saw a structurally important financial institution in distress, and they went in and rescued them. But by August, the crisis deepens, right? So they thought, okay, Bear Stearns is overexposed to the subprime mortgage market, so we'll rescue Bear Stearns. We won't let it go under, and we'll make Bear Stearns pay some consequences for its profligate exposure to the subprime market, but it's fine. But by August 2008, the crisis deepens, and nearly 1/4 of subprime mortgages are at least 30 days past due, right? More and more people are walking away from these subprime mortgages. And what realization dawns upon people by September 2008 is that it is not just a Bear Stearns problem. In March, it was considered a Bear Stearns problem, a major problem for Bear Stearns, probably a minor problem for other banks. But in September 2008, Lehman Brothers announces that it is filing for bankruptcy because it was overexposed again to the mortgage-backed security market. And the Fed and the Treasury decided that they were going to let Lehman fall. Okay. The reason to let Lehman fall was again the same old considerations around the moral hazard problem, that They wanted to help Lehman, but they realized that if there's Lehman was so profligate in its activities that the Fed and the Treasury tried to find a buyer for Lehman. Right. So if you look through the documentaries in this period, there's a lot of wonderful PBS frontline documentaries about the financial crisis. You see what and the Too Big to Fail documentary on HBO. If you have an HBO subscription, that's amazing as well. But what you find is that both Hank Paulson and Timothy Geithner, Hank Paulson at the Federal Reserve and Timothy Geithner at the Treasury, at the US Treasury, they were trying to find a buyer for Lehman Brothers, but they couldn't find one because their balance sheet was in such terrible shape given their overexposure to the subprime market that they couldn't find a buyer for them. And they didn't want to rescue them, and Lehman Brothers essentially fails. The next domino to fall is Merrill Lynch. So once the Fed and Treasury decide, okay, Lehman Brothers is going to fall, where investors are going to get wiped out, they deserve it. And then basically a day later, the shoe drops that Merrill Lynch, the third or fourth largest investment bank on Wall Street, is on the brink of bankruptcy because of its exposure to the mortgage-backed security market. And then the Fed and Treasury realize that it's not just a Bear Stearns problem, it's not just a Lehman Brothers problem, it's not just a Wachovia problem, it's a system-wide crisis. And then they will negotiate, basically put together a deal where Merrill Lynch sells its most profitable portions of itself to Bank of America, and its toxic assets of Merrill Lynch are backed by a guarantee from the Federal Reserve. I think it was something like $10 billion worth of toxic assets on Merrill Lynch's books. The Fed will basically buy and hold on to, and that would inject more liquidity into Bank of America to finance its purchase of Merrill Lynch. Okay. So as the music stops, there's again a great book by Alan Blinder called After the Music Stopped about the financial crisis. As the music stopped, many parts of the financial system became frozen, and trading in this MBS securitized loans market basically stopped. Okay. The federal government realized, as I said, that it was not just a problem which was going to be limited to Bear Stearns, Lehman Brothers, Merrill Lynch, as then AIG said it was in distress, Freddie Mac and Fannie Mae were in distress, Citigroup found itself in distress, JP Morgan was facing losses. Every single major bank in the US was connected to the mortgage-backed security system, and they were all faced with a massive crisis on their hands, right? So the Federal Reserve for the longest time had been just the regulator for the commercial banking system. But now the crisis emerges from the shadow banking system. All these mortgage originators and bundlers and all of these operated largely out of the purview of the Federal Reserve, and they didn't really realize that well into 2007 that the subprime crisis, which I thought was like, okay, there were like some crazy lenders out there who wanted to lend to these people, and they were taking massive risks. And what if they go bust? Because they are taking on massive risks, they deserve it. But they didn't realize up until the middle of 2007 how severe the crisis was and what the exposure was of all the major banks on Wall Street to the subprime mortgage market crisis. And the first policy lever that the Fed decides to employ is to pull on the interest rate lever, right? To reduce interest rates as much as possible, aggressively start cutting interest rates in order to improve the liquidity conditions. The access to credit becomes cheaper, improves liquidity in the market. The federal government then took on the extraordinary step of nationalizing both Freddie Mac and Fannie Mae, two government sponsored enterprises, GSEs, these are called, where basically the government is a big owner, majority stakeholder in these two firms, but they're private firms which are basically in the mortgage business. And given the crisis in the mortgage market, these two companies were basically going to go bankrupt, and the federal government effectively nationalized Fannie Mae and Freddie Mac. And the Treasury moved to inject a lot of liquidity into the money markets as well, in order to staunch runs in those markets as well, to stop runs in mutual funds. Okay. So in 2008, the Fed and the Treasury unveiled this package, this rescue package for the banks. $700 billion was authorized, to purchase mortgages and mortgage-backed securities from financial firms and other investors. So the US government basically would take these toxic assets off the balance sheets of these banks, and in turn they would give them cash, and that would inject liquidity and recapitalize these banks, and they would prevent these banks which were completely liquid from going insolvent and going bust, right? So this program is what is known as the TARP, the Troubled Asset Relief Program, and they made direct preferred stock purchases in banks, right? They took on partial ownership stakes in these banks till the crisis was, met, right? And since then, the Treasury has periodically, every 2 years, now banks have what is known as CCAR requirements, where they have to undergo what's known as a stress test. So what the stress test does is that the Federal Reserve administers these different scenarios, different liquidity and different crisis scenarios to the bank's balance sheet, and sees if they can weather it without government help. Okay, so they administer stress tests to 19 large financial firms in order to reassure investors that these banks are fundamentally sound, and the Fed and the Treasury stood behind them. But we already considered what the attendant consequences were, this too big to fail problem, and now more than ever, the financial system is much larger than it even was in 2007, 2009. So that gives you an indication of what has happened since then. Okay. All right. The last thing that I would like to go over briefly is to discuss this connection between financial crises and financial regulation, right? At the end of it, we know what happened during these two crises. Now, what kind of regulations were passed and what happens, okay? So if you think about this regulatory cycle, so new financial regulations, generally, government passes new financial regulations in response to a crisis, right? So there is a regular pattern. First, a crisis happens, then regulations are passed, then there is a response to new regulations by firms, and then there's a response by regulators, and the cycle perpetuates, right? So the first, in the aftermath of the runs in 1907, the bank runs in 1907, the bank panic in 1907, the Federal Reserve was instituted to be the lender of last resort, right, to provide liquidity to banks during bank panics. But what happened was that in the crisis, in the Great Depression in 1930s, the Fed failed to uh, failed its first crucial test when it just stood by and allowed the banking system to just go up in flames. As a response, the Congress decided that they needed new regulations. So they first established FDIC, the Federal Deposit Insurance Corporation. So that was to basically reassure investors that they didn't have to make a run on a bank, that their deposits were insured by the full faith and credit of the United States government, and then to reorganize the structure of the Fed itself into what is known as the FOMC, the Federal Open Market Committee, so that the decision making inside the Fed was not as diffuse, that there's a centralized body which is given the authority to manage the Fed's policy. Okay. The history suggests that in the post-war period, the Fed has performed fairly well, right? So the post-war period, there were a few crises, and the Fed performed admirably during each of these crises. In 1970, when the quality of commercial paper is just a fancy way of saying short-term borrowing by corporations, right? There's a commercial paper market. These are borrowings, bonds. The difference between commercial paper and corporate bonds are usually have longer maturities. Commercial paper is short-term borrowing, okay, much shorter term borrowing. So there in 1970, there was a crisis in the commercial paper market, which was issued by large corporations. The Fed came to the commercial, rescued these commercial banks with loans, right, in order to capitalize. In 1974, there was the case of the Franklin National Bank. It was experiencing a bank run, and again, the Fed stepped in as a lender of last resort and injected liquidity back into the bank and saved the bank as well. During the savings and loans crisis in 1987, during the crash of October 1987, this is when Salomon Brothers went bust. Fed Chairman Alan Greenspan at that point announced that the Fed was ready to inject as much liquidity and support to the financial system as it needed. That this was known as the Greenspan put, or the Fed backstop, right? If you see those two phrases in the financial press, that's what's known the Greenspan put, or the Fed backstop is a way of just saying that the Federal Reserve acts as the backstop. It doesn't let the contagion spread to all the other banks and the entire system collapses. That if there's a crisis, the Fed will step in and inject the required amount of liquidity and regulations that are needed in order to rescue, troubled banks and institutions. In 1984, this is where the original phrase comes from. The comptroller of the currency submitted the study to Congress with a list of banks that were considered quote unquote too big to fail. Okay. Too big to fail, a failure. What does it mean by too big to fail? It just means that if any of these banks, these systemically important banks, if any of them fails, then it poses a systemic risk to the financial system, and the entire edifice of the financial system could come down. Okay, so the too big to fail policy then the government adopted is that federal government does not allow large financial firms to fail for fear of collapse, right? For the fear of the entire system collapsing. So the government has adopted a policy which said that these structurally important banks, no matter what they do, basically we will not let them fail. And if those are the incentives that you give to bankers, you can only imagine what comes after that, right? So banks that were not allowed to fail, in effect, had unlimited in de facto, I should say, had unlimited deposit insurance, right? So that increases moral hazard. Why does it have unlimited deposit insurance? If the government stated policy coming from the comptroller of the currency, Congress, and the Federal Reserve is that all these banks which we deem to be too big to fail are not going to be allowed to fail under any circumstances. The banks can take on any kind of wild risk that they want, and no matter how profligate their activity is, the Fed will always step in, the Congress will always step in and not allow them to fail, right? And the policy has come under a lot of scrutiny and criticism, obviously, because it treats large banks and small banks so differently. So what is your incentive as a bank, right? Your incentive as a bank is to become as large as possible. So the larger you are, the more structurally important you are to the system. So the larger you are, so you want to buy as many banks as possible, do as much M&A as possible to grow as large as possible, because basically what you get out of it is this umbrella which is over your head, which is held over your head by Congress and the Federal Reserve, which allows you to operate on a much more risky basis because you have this de facto unlimited deposit insurance. Okay. So in response to all of this, in 1991, Congress passed what is known as the FDICIA, the Federal Deposit Insurance Corporation Improvement Act, which basically mandates that the Fed, when a bank is distressed, that the Fed needs to wind down these banks in a way which is least costly to the taxpayer. Right? The FDIC, the Federal, not the Fed, sorry, the FDIC, the Federal Deposit Insurance Corporation, which is who is in charge when a bank fails, is that when a bank fails, the reorganization of the bank and the restructuring and the asset sales of the bank and all of the attendant processes during the bankruptcy of a bank need to be conducted in a way which is least costly to the taxpayer. Okay. But the crucial clause in that act and the FDICIA is that this requirement is waived off of being least costly to the taxpayer is waived off. This exemption is given in the case in which the failure of a particular bank would cause serious adverse effects on economic conditions or financial stability. So again, too big to fail is further reinforced, right? So on the one hand, the act is saying, okay, if a bank fails, FDIC is in charge of handling the bankruptcy of that bank and winding down the bank or restructuring the bank and whatever it is. But if that bank is so large and it has FDIC needs to do it in a way which is least costly to taxpayers, so it can't like just pump in enormous amounts of money into the bank and hope the bank gets better. That's not possible. The exception to that is that if the bank is so important that it can't be allowed to fail, then you do whatever it takes to keep the bank afloat. Okay. And during the financial crisis of 2007-2009, that exemption that was carved out in the FDICIA proved to be quite important, right? So in March 2008, the Fed and Treasury intervened. When the first tremors of the crisis reached the front doors of base terms, the Fed and the Treasury did intervene. Economists and policymakers immediately started arguing that this moral hazard problem in the financial system. Okay, so there was a lot of ink which was spilled in the financial papers. Economists were writing all over the place, policymakers were writing all over the place, op-ed pages in the Wall Street Journal, the Financial Times, and the New York Times. All the major newspapers were carrying these things of why is the Fed or the Treasury rescuing a bank which got into trouble because of its own risk-taking behavior, right? So that might have played a huge amount of, given the public scrutiny and the outcry from the rescue of Bear Stearns, when it was Lehman Brothers' turn to get rescued, the Fed and Treasury decided to not do it because the public criticism was so high after they rescued Bear Stearns that they didn't want a repeat of that by rescuing Lehman Brothers. But then once Lehman Brothers collapses, its major counterparty, the AIG group, the American Insurance Group, International Group, which was in the business of insuring the mortgage-backed security. So the way the model worked was that you would buy a mortgage-backed security, and you could buy insurance against default of this mortgage-backed security. So in case of default, AIG would come in and make you whole. In the meantime, you would just keep paying insurance premiums to AIG. So AIG was quite happy with it. They were insuring these things, collecting premiums, and it was fine. But once the subprime mortgage crisis engulfed all these major banks, the biggest party on the hook, the biggest insurer of these mortgage-backed securities was the AIG group. And then the Fed had no choice but to take over this firm. For 80% ownership of the firm, the Fed made a large loan to AIG and took over 80% ownership stake in the firm. Okay. So here you have the schizophrenic response, right? You rescue Bear Stearns, it suggests that too big to fail is the dominant policy. You let Lehman Brothers fall, you don't think that too big to fail is the policy. Then you rescue AIG, it suggests that too big to fail is possible. But what we find from the aftermath of the crisis is that given the widespread intervention in all the major banks and all the major financial institutions in the US from the government, basically too big to fail has really been the dominant policy. The only exception to that rule was Lehman Brothers, and as soon as Lehman Brothers collapsed, the entire system began to blow up, and that basically made the Fed and Treasury, reaffirm that too big to fail is the policy of the Federal Reserve, and that is the new role of the lender of last resort that the Federal Reserve is forced to play. Okay. So in response to all of this, in 2010, Dodd-Frank was passed, and Congress rewrote a section of the 1913 Federal Reserve Act. Okay. What this did was it tried to tie the hands of the Fed from the kind of things that it could do in the next crisis. So what did it do? So what it said was that the Fed was barred from making loans for the purposes of assisting a single and specific company to avoid bankruptcy. So what does it mean? So the too big to fail policy is only going to be applicable where you rescue a bank. If it's not just the only bank you want to rescue, you want to rescue other banks because other banks are also affected by the failure of that bank. So if there are a bunch of different banks all needing help at the same time, the Federal Reserve can act and prevent bankruptcy of the one bank, which will cause the bankruptcies of all the other banks. But if it's just one company and go under and then other banks are not affected by it, the Federal Reserve can't intervene. Okay. So the loans that the Federal Reserve made to both JP Morgan Chase and AIG in 2007, 2009, those kinds of loans are no longer permitted because those loans were made with the explicit purpose of saving that particular firm from bankruptcy. If AIG went bankrupt, other banks would take losses, but they wouldn't be bankrupt. But, so one key reform of the Dodd-Frank Act was to say, okay, You can't just rescue one specific company. If you're going to intervene, you have to intervene on behalf of the system, not on behalf of a single company. Okay. In addition, the new regulations say that any new programs beyond lending to commercial banks would require the approval of the Treasury Secretary. That the Fed can't. It reduces the Fed's independence a little bit by putting these decisions beyond what is, beyond the commercial bank regulations, uh, uh, to be tied in with what the U.S. Treasury. So it brings the Fed's independence under the purview of the US Treasury a little bit, so that they're not allowed to just rescue banks willy-nilly. Okay? So the 2010 financial overhaul, did it end too big to fail? Right? Congress's intention was clear, right? That by passing what was known as the Wall Street Reform and Consumer Protection Act, which is colloquially called Dodd-Frank, in 2010, the Fed allows the government now basically allows the Fed, the FDIC, and the Treasury to basically seize and wind down large financial firms, right? Previously, this power to wind down financial firms only rested with the FDIC, but they expanded the scope of it. So the Fed, if it decides a bank is run too horribly or riskily, that they have the power to wind it down. The Treasury can do the same. Earlier, it was just the FDIC. So the FDIC was the only regulator. Now it has 3 regulators on top of the system. So at least the intention, and that's the analysis from the FDIC, is that this new regulation would lead investors to want to choose smaller firms that have lower information costs on determining the riskiness of investments, right? So basically, uh, it reduces the incentives of banks to get as large as possible, because larger firms would have to provide investors with higher expected returns to compensate them in the absence of a large bailout, right? Because of the too big to fail policy getting tightened a little bit. Okay. So this is about lender of last resort. It's the cycle. You can see the cycle enact itself. So the crisis occurs. So there's a wave of bank failures in the early 1930s, which begins to worsen the Great Depression. As a consequence, the Fed establishes the Federal Deposit Insurance Corporation. The financial system responds, or the financial system, goes on and gets itself into trouble again, because the Fed's more vigorous lender of last resort policies basically gives them not only the FDIC's insurance, but they also have unlimited insurance from the federal government in the case they're so big that they're structurally important to the system. And then again, the regulators respond to this behavior by passing Dodd-Frank, which restricts the Fed's too big to fail policy. Okay. All right. The second thing that we want to address here is about how do we reduce bank instability? Okay. How do we make banks more stable so that you don't never want to be in a crisis and then putting out fires. You much rather figure out ways as to how to avoid getting banks into a crisis. One argument which has been put forward is to regulate how much competition, how many banks there are, and how much competition there is between banks. What does it mean? If there is less competition between banks, then this incentive to chase returns is not as high, because if there's a lot of competition, everyone is chasing returns all the time, which dials up the amount of risk that these banks are willing to take in order to beat their competitors. And one argument is that reduced competition among banks could reduce instability, right? So, but in the long run, the downside to this, or in the long run, the idea here is that if the if there are anti-competitive regulations that on big banks, that big banks can compete with each other on all manner of business, whatnot, then you might have this mushrooming of unregulated financial institutions and small banks and small fintechs to take their place. And we've seen a mushrooming of that, right? You've seen all these fintechs which have come up in the last decade, right? From Square Cash to Affirm and Prosper and what have you, and SoFi and so on and so forth. All these fintechs are occupying the space which was previously occupied by these big banks. So Regulation Q is one regulation which was established under the Banking Act in 1933 to limit competition for funds among banks, right? So how does Regulation Q work? So Regulation Q just puts a ceiling, right? Puts a ceiling on how high interest rates can be on time and savings deposits, right? So how do banks compete with each other, right? How do I attract more deposits to my bank? I essentially offer higher interest rates, right? If my neighborhood bank is offering 1% on their savings account, I'll offer 1.2%. Then they see that they might raise it to 1.4, I might raise it to 1.6, and we might compete like this. But Regulation Q basically puts a ceiling on how high these deposits are. Okay. But in the 1970s, what happened? This is the period when there was a lot of inflationary pressure in the U.S. economy. Inflation rates basically drove these interest rates, because interest rates need to keep in track. If you are going to keep the real interest rate constant, then the nominal interest rate needs to rise at the same speed as the inflation rate. So if you have a lot of inflation in the economy, what happens to nominal interest rates? They need to go up. And interest rates went above the Regulation Q ceilings, and then that had an adverse impact where people were substituting their savings accounts, substitute money market mutual funds and other things for deposits in banks. Because once you hit that ceiling, if you can get a higher return in your MMA account or the money market mutual fund account or other investment vehicles, that's what you want to park your money. Which are almost as liquid as savings accounts, but you might get a higher return. So Regulation Q has this again adverse like this perverse impact related to what it is. Yeah. The second idea about reducing bank instability is this notion of disintermediation. Okay. This notion of disintermediation happens when banks do not have savers funds to loan, right? So what does it mean? So banks end up, in that case, banks end up with only low quality borrowers, as firms went on and sold a substantial part of their commercial paper in the money market mutual fund. So because there is only a limit on how high interest rates this Regulation Q limited how high these interest rates on banks could go, firms didn't want to just keep their deposits in these banks, and instead they went into the commercial paper market, sold a substantial fraction of the commercial paper to money market mutual funds, because that's where the investor demand was. Because people didn't want to leave their money in deposits at the banks, because these money market mutual funds are offered higher interest rates, and that's where people, right? So disintermediation is this process where you see this exodus of savers and borrowers from banks to other financial markets, right? To the stock market, to the money market, to forex market, to the foreign market, so on and so forth, any different derivatives market, so on and so forth. Okay, so disintermediation is this um, idea where there is an exit of savers and borrowers from banks to other financial markets. Okay. So in order to circumvent Regulation Q, banks developed new financial instruments for savers. So they came up with these negotiable order of withdrawal accounts on which they paid interest, so negotiable certificates of deposits. All of these were innovations out of Citibank. And they also developed this automatic transfer account system, the ATS accounts, that effectively end up paying interest on checking. So they came up with all these other ways to circumvent Regulation Q, because the Regulation Q made competition on rates for deposits not feasible. Once rates had risen high enough to hit the ceiling imposed by Regulation Q, you can't compete directly on the rates that you pay on your savings accounts. So how do you compete? You compete by introducing new features to your checking accounts. You introduce new checking accounts which effectively pay you interest, and so on and so forth. You keep coming up with new ways to circumvent Regulation Q and increase the amount of deposits you can take. Okay. As a response, what did regulators do? The regulators decided that it didn't make sense. This Regulation Q was doing more harm than good. So the DIDMCA, the Depository Insurance Deregulation Money Control Act of 1980, and the Gans Saint Germain of 1982 basically eased out regulation Q, right? So it allowed banks to once again compete on the rates that they offered on their deposits, but they also allowed banks, so they reduced disintermediation by allowing banks to offer money market deposit accounts themselves. So instead of people leaving the banks in order to open up a MMDA and depositing their money there and earning interest rates there, now banks themselves could open this account on behalf of these customers in their own this thing and taking deposits into these MMDAs as well, right? The money market deposit accounts. So again, you see the same cycle repeat itself, right? With interest rate ceilings, with regulation Q, as we call it. So crisis occurs. 1930 to 1933, the crisis, public loses confidence in the banking system. And then as a consequence, as they lose confidence in the banking system, what do savers do? Savers decide that they don't want to leave their money at the banks. They want to hold it in the form of currencies and force banks to liquidate their loans. The regulation is enacted. There's so much instability in the banking sector that Congress responds by passing Regulation Q, which limits how much competition there is between banks on deposit interest rates, right? By imposing ceilings on how high these deposit interest rates could be. The financial system responds. What happens? Money flows out of a lot of people decide that once, especially during the 1970s, as interest rates continue to rise and then hit the ceilings of regulation Q on deposits, more and more money flows into the money market accounts, and there's just a trend of disintermediation that sets in. As a response, the regulators respond. They pass the AIDMC and the Gans and Germain Act, which basically does away with regulation Q and also allows banks now to take those money market deposits directly at the banks, to allow them to open MMDAs directly at the bank. Okay. All right. The last regulation I want to talk about is this new one. This is a newest one that they have, which is known as capital requirements, right? This is the CAMEL system. There's a CAMEL's rating system which was developed, and this is after a stress test. So the bank is examined, the bank's balance sheet is examined, it's administered a series of different tests, and then it's given a grade in the form of what is known as a CAMEL's rating. It's rated on these 6 things. It's rated on capital adequacy, it's rated on asset quality, on management, on earnings, on liquidity, and then it's rated on sensitivity to market risk. Okay. So capital requirements is these regulations that require that banks maintain a minimum amount of capital that are contributed by the owners of the firm. So it has like the level of bank capital bank capital can't fall below certain requirements, and there needs to be enough participation from the bank's owners in the operations of the bank. This is a way of reducing moral hazard and also introducing, as Nicholas Nassim Taleb calls it, skin in the game. Because the more of your money is, the owner's money is at stake along with depositors' money, there is less misalignment of incentives between owners of the bank and depositors of the bank. Okay, so regulators increased these capital requirements in the aftermath of the savings and loan crisis in the 1980s, when they realized that a lot of these banks were undercapitalized. And this is what we call macroprudential regulation, right? Regulating capital is an example of what is known as macroprudential regulation that attempts, what do we mean by macroprudential regulation? This is an attempt to reduce risk in the financial system by increasing the likelihood that the owners, that when losses come calling at your bank's doorstep, it's not just the depositors who are on the hook, but the owners on the bank can absorb the cost of the firm's losses. So they are the first people who will absorb the losses, and then if the losses go further beyond whatever bank capital is available there, then only then do depositors start to get exposed to the losses of the bank. Okay. So following the savings and loan crisis in 1987, the Basel Committee was formed. The Bank for International Settlements, the BIS, which is located in Basel, was formed. The Basel Committee on Banking Supervision developed this accord called the Basel Accord, and this keeps getting revised every few years. So there's Basel 1, Basel 2, Basel 3 is where we are at, these new sets of regulations, right? So it's an international agreement about bank capital requirements. So there's a harmonization of bank capital requirement rules across the world. So all countries adopt, or not all countries, they're signatories to the Basel Accord, and every signatory to the Basel Accord agrees to have the same set of standards for the banks that operate under their purview. Right? So under the Basel Accord, one thing to note is that bank assets that the bank owns are grouped together based on their degree of risk into four categories. And the fourth category, using these four categories, you can calculate a measures of what is known as risk-adjusted assets by multiplying the dollar value of each asset by a risk adjustment factor. So, okay. So in layman's terms, what it means is that you look at all the assets of the firm, you tranche, you basically separate them into four silos. One is least risky, the second one is risky, the third one more risky, and then the fourth riskiest class. And then you come up with this new measure, which is known as the risk-adjusted assets, where you take the value, the dollar value of each of these bins that you've separated the assets into, and multiply them by a factor which represents the amount of risk that that particular category of asset carries, right? All right. And the next thing is about the capital adequacy ratio, right? So a bank's capital adequacy is usually measured using two measures. There is what's known as the tier 1 capital and then tier 2 capital. Okay. So this is about the denominator, right? So tier 1 capital consists mostly of bank capital or shareholders equity. So you're just using that's the adequacy. So if you want to take the ratio, so if you want to calculate the capital adequacy ratio, take a look at when you're using tier 1 capital, you just take the value of the bank capital and divide it by this risk adjusted assets value that you calculated using this methodology, which is given in the Basel Accord. Okay. Tier 2 capital is a more expansive version of it. It not only takes into account the bank capital, it also takes into account the bank's loan loss reserves. So the banks usually provision a small amount of money in case of when they face losses on the loans, and they're provisioning for that. So that's taken into account in tier 2 capital. It's subordinated debt is inside the capital, so junior forms of debt are in that capital, and then there's other balance sheet items beyond the scope of this. But I just want to bring it up that you realize that it's tier 1, tier 2 capital. So once you can use these, so the things to take into account is that there is this new CAMELS rating system. The banks are rated on 6 different metrics, right? So on capital adequacy, on asset quality, on management, on earnings, on liquidity and sensitivity to risk. The second thing to take into account is this: the Basel Accord, the Bank of International Settlements in Basel passes these. This is a cross-country agreement, where they come up with how to measure capital adequacy. And the preferred method to measure capital adequacy is to first tranche the bank's assets into 4 different silos of different risk qualities, multiply the dollar value of each of these silos by some risk adjustment factor, add them all up, and then using either tier 1 capital or tier 2 capital, you can come up with a capital adequacy ratio. And based on that, you can describe the banks on these metrics. So if the tier 1 capital ratio, so again, this is basically tier 1 capital, which is basically bank capital over the risk adjusted assets based on the Basel norms. If it's 8% or greater, it's considered well capitalized. If the total capital ratio, this includes tier 2 capital. So you add up tier 1 and tier 2 capital together. So then if it's 10% or greater, then it's considered well capitalized. Adequately capitalized, 6% or greater of tier 1 capital ratio, 8% or greater on the total capital ratio. Again, total capital ratio is tier 1 capital plus tier 2 capital divided by risk adjusted assets as calculated under Basel norms. Undercapitalized is less than 6% capital ratio. Significantly undercapitalized is less than 4% tier 1 capital ratio, and critically undercapitalized is less than 2% capital ratio. Okay. So what is the point of all of these capital requirements? Capital requirements allow us, once you implement these Basel III norms, what you have is that if the banks have low capital ratios, then they are forced to either close or to raise additional capital, or to ask their owners to put in a little bit more money into the bank to capitalize the firm. Okay, so as a response, what we find is that large commercial banks have now, these off-balance sheet items have grown in scope for large commercial banks, because that allows them, by pushing off certain activities off the balance sheet, that allows them to get away with uh, you know not having not forcing them to constantly call equity capital in order to make sure that the bank is well capitalized, right? So some large banks, like for Citigroup for instance, form what are known as SIVs. So these you find all, Citibank started it, but everyone does it now, these special investment vehicles to hold risky assets, and these are off balance sheet, right? So by the time of the financial crisis, there were about 30 SIVs holding about $320 billion in assets. And that's a lot, right? $320 billion of off balance sheet assets, right? All right. So the assets, as the assets held by SIVs lost, value during the crisis, banks are forced to recognize those losses and then bring them back onto the bank's balance sheets, because if they are going to staunch those losses, they need to be on the balance sheet, and then you can deal with those losses. But again, you see with capital requirements, is the last regulation that we were talking about. Again, you see the cycle. In the 1980s, in the aftermath of the S&L crisis, the savings and loan crisis, the realization that regulators came up with was that banks were not capitalized as well as they should be. So the United States then joins other countries in the Basel Accord, which strengthens not only the capital requirements, but also harmonizes capital requirement rules across a variety of different financial markets. So the financial system then responds to this by doing what? By essentially creating off-balance sheet items called SIVs, and to hold their riskiest assets in these off-balance sheet uh, vehicles. And again, regulators respond, and they further increase. In Basel III, the requirements have gone up further. The United States and other countries negotiate further to increase capital requirements under the Basel Accord. Again, you have the crisis, regulation, response to regulation, and more regulation. Okay. All right. The last thing is about the financial crisis, the regulatory response to the financial crisis. And again, we'll see the cycle repeat itself. So the Dodd-Frank Act was the key response to the financial crisis of 2007, 2009. And the key elements of it, first, it created what was known as the Consumer Financial Bureau, Protection Bureaus, this CFPB. This is the brainchild of Elizabeth Warren, who came up with this new regulator. This was to protect consumers from predatory lending activities, right? So protect consumers in the borrowing and investing activities. It also established what is known as the FSOC, the Federal Stability Oversight Council. So the Federal Stability Oversight Council generates these reports and administers these stress tests to these banks in concert with the Federal Reserve and the US Treasury to identify and act on systemic risks in the financial system. It also, in a small way, ended the too big to fail policy for large financial firms. So in statutory terms, it might have ended too big to fail, but in practical terms, it hasn't. It made several changes to the Fed's operations. It streamlined a lot of the Fed's operations and brought some of the Fed's powers under the ambit of the US Treasury. There was some restrictions which were passed around, derivatives trading, where they were removed from the OTC market and were brought onto the financial markets. That's uh, not really, we haven't really discussed derivatives that much in this class, so that might be a little, to explain that is going to require me to explain derivatives, so we won't get into all of that. And then they implemented the so-called Volcker rule. And we already talked about Volcker rule, which basically means that they ban proprietary trading at commercial banks. Proprietary trading is this practice of where you mix up the capital that is contributed by the bank's owners with the capital of with the depositors' money and use that for trading activities. You're not allowed to do that anymore. Okay. Other key provisions, they required former, big institutions in the shadow banking industry like hedge funds and private equity funds to also be registered with the SEC and then under the regulatory purview of the Securities and Exchange Commission. That's what the SEC is. And require that firms selling mortgage-backed securities and similar assets retain at least 5% of the credit risk. So you can't just offload all of your mortgage-backed security exposure to other firms and make money that way. You have to you also have to have some skin in the game. So at least 5% of the exposure that you sell off needs to be retained on the firm's balance sheet. So again, the financial crisis of 2007 with the housing bubble beginning in 2007 leads to falling net worth of households and again disruption of the financial system. The Treasury and the Federal Reserve Act, they passed TARP and capital injections through TARP, the Troubled Asset Relief Program. This aggressive lending by the Federal Reserve, the interest rates are cut to zero. And then the financial system responds by, the firms and banks and other financial firms are forced to increase their capital because there are higher capital requirements, deleverage, reduce amount of debt that they carry, and become more risk averse in their loans and their investments. And then regulators respond again by passing the Dodd-Frank Act, outlawing certain practices, bringing certain, putting limits on certain other aspects of it. Okay. So that's basically the discussion around financial crises, the two big ones, the Great Depression and the recession of 2007, 2009. I'm pretty sure the next time I teach this course, we'll add on the coronavirus pandemic and the policy responses to it by then. But that's basically it, right? And then we talked about all the regulatory, the cycle, the regulatory cycle, the crisis, the response to the crisis, regulatory response to the crisis, firms adapting to the new regulations, and then regulators are forced to form further new regulations and so on, and the game continues, right? So again, if there's any questions, leave them in the comments below the video, send me an email, see me in office hours. Thanks for listening, and I'll see you in the next one. Bye-bye.